some key topical areas that I've mentioned that are very important for you. We have conceptual framework, and also we have regulatory framework. You have to revise this conceptual framework, and in this conceptual framework, if you remember, I taught you that they are the basis on which financial or on which accounting statements, they are the basis for preparation and development of accounting standards generally. So we developed accounting standards based on the conceptual framework. So basically what you need to know, or you should have read under this conceptual framework, is you should be able to tell the examiner about the objective of a general purpose financial report. So they can ask it. And another thing they can ask under this general purpose is, who are the primary users? Primary users of a financial report. And they can also ask you, these primary users, what decision do they use? Do they make on the basis of the information we provide to them? So I've seen a diet where they asked you that based on the conceptual framework of 2018, they asked you should list and explain the financial information that is provided to primary users. So if they ask you something like that, and you're saying statement of profit or loss, statement of financial position, statement of changes in equity, you'll be wrong, because that's not the financial information. According to conceptual framework, the financial information are economic resources of the entity, the claims against those resources, and changes in those claims and economic resources. Those are the issues that objective is dealing with. Also, you should be very convenient to tell the examiner about the qualitative characteristics of a useful financial report. And if you remember, we have the fundamental and we also have the enhancing characteristics. You should be convenient explaining faithful representation and also relevance, because these are the fundamental characteristics. And also, you should be able to explain the enhancing characteristics from comparability to verifiability to timeliness to understandability. They can ask you in the exam. So you have to be at home with the qualitative characteristics of a useful financial report. And another key one that you need to be able to know, of course, you need to know the element of financial statement, but what is more important is the recognition of elements of financial statements. So, and the recognition here is looking at the recognition criteria according to the conceptual framework that we actually mentioned. So you should be able to tell the examiner those two recognition criteria, saying that they must, you recognize these elements when they meet the definition of the elements of the financial statement. So as soon as they meet that definition, in fact, everything the recognition criteria is really talking about is that when an element complies, when an item complies with the definition of element, go ahead and recognize in your books. And don't forget the measurement basis. Last diet, they asked this, right? But be sure that they could ask any other one, even if they don't ask this. So don't forget the historical cost basis. Don't forget your fair value basis. Don't forget your value in use. Don't forget present value. Don't forget current costs. Don't forget neutralizable. All of these bases of measurement that we have learned all through our course of this class, you should be able to define these items. So another important one is the concept of capital and capital maintenance. So it's been a while they asked this, and we did that in the very early days of our classes. And I told you there are two concepts of capital. There is the financial concept of capital, and there is the physical concept of capital. The financial concept is looking at capital as a monetary value, as a monetary amount. And the physical concept of capital looks at capital from the standpoint of productive capability and operational capacity in terms of what the entity can produce. So also is capital maintenance, which can also be financial capital maintenance and physical capital maintenance. In both cases, whether financial or physical, you have maintained your capital when you make profit. As soon as your opening capital is lower than your closing, that means you have made profit. In both cases, you have maintained your capital. The difference is that the physical concept of capital, the physical capital maintenance usually considers time value of money, it considers inflation. So before it determines that, okay, you have made profit, it will take into consideration increase in prices. Okay, so for the first topic I taught you, you need to be comfortable with this skill because these are the areas I kind of asked questions in the past. So we then looked at regulatory framework. For regulatory framework, you need to be convenient with the rule-based framework. You need to know what we mean by rule-based framework and principle-based framework. If you remember, I told you that IFRS is principle-based framework because we make use of judgments, we make use of estimates, we allow users to make decisions and conclusions. But rule-based is not what we use in Nigeria. So our reporting framework in Nigeria is principle-based. So you need to be able to explain the difference between those two. And also, you need to know the sources of regulations in Nigeria. We have the accounting standards, we have the company law, we have the local stock exchange listing requirements. So you need to be able to appreciate that before Tuesday. If you haven't revised that before, let it be in your mind. Another one is reasons for regulation. Why is regulation necessary? Reasons for regulation. Why is regulation necessary? Why do you have to regulate reporting? Okay, so at least you need to know maybe 4 reasons why regulation is necessary for entities. I mean, it's important because it ensures that reporting users or investors are not misled. It ensures that entities comply with the reporting framework. Okay, and some other reasons that you should be able to come up with. So you need to get used to that. And the final one is the steps steps in developing IFRS. Go and learn those steps. Go and revise it. Go and revise this step. So I'm not going in detail in all of this. So for this first part, I just want to remind you, and I'm reminding you because it's easier for you in the exam to quickly pick points from these areas. Just ensure you read it. If they don't ask it, I mean, it's fine. But if they now ask it in the exam, because we have seen that in all of this I've mentioned, you see them asking questions every night. It will not be nice that you now don't know it. You left it because you don't know it. That is not so good. So, and after then, I moved on to IS 1 on presentation of financial statements. You see, um, what you can find them asking you around this, what I've seen them asking around this so far is the content content of a director's report. And which we saw together in a past question. If you remember when we were reviewing past questions together, because IAS 1 does not deal with specific item, specific element. The core of IAS 1 is just around the structure and the content of a financial report. That's what IAS 1 dealt with. How does a financial statement look like in terms of the statement of profit or loss, statement of financial position, statement of changes in equity, statement of cash flows, and notes comprising disclosure of accounting policies. So it gives us that minimum content for those. So aside that, you see, there are other disclosures in an annual report beyond just financial statements. Okay, of course, IAS 1 will also be responsible for that. And when it comes to director's reports, you will see issues like the company's principal is what the company does. This is what we do. You see the company's involvement in training and capacity building. You see the company talking about, okay, what are the CSR activities that we have carried out for this period. In fact, very importantly, is the directors, the list of directors, and their interests in the company. So this one will talk about maybe some charitable, this CSR, any charitable contributions. In fact, this aspect can also really talk about when did the company commenced and when was it registered, commencement of operations. Can also talk about the external environment or the macroeconomic environment of the company and some other issues like that. And I mean, another thing IAS 1 looks at is the general features of a financial statement. And conceptual framework dealt with this considerably. Okay, the best they can ask you in this area is that you should explain the general features of a financial statement in line with IAS 1. And we have what are the general features? We have the one that first comes to my mind is consistency of presentation. We have periodicity in terms of in fact, let me put it as frequency of reporting. Let me put it as frequency of reporting. We have going concern. going concern assumption. What is important here is I've not seen them ask this really, but these are areas I think that you can just scan through in case, because for your exam it's easy for you to answer questions like this if you have them. If they are not there, there's really nothing much you can do. But if they are there, I mean, they are talking about consistency of presentation. In reporting, that's a general feature. Whatever approach you use in reporting this year must be the approach you use in subsequent years, right? Or frequency of reporting. So usually when you are presenting your financial statement is annual, but it's possible that your financial statement can be more than 1 year or less than 1 year, which is also okay, but you need to let the user know that your financial statement is then not comparable anymore. Okay. And a lot of other ones like comparability is part of the features. We have accrual basis of accounting. Yeah, like 8 of them, like that. Okay, so basically that's the core of IAS 1. And also we looked at PPE, and even though you will not find the examiner asking you definition of PPE, but this is something I feel that you should be convenient with. What's the definition? How do you define property, plant, and equipment? Any tangible item that is held for use in the administration, in the production, in the supply of goods or services, or rentals to others, and it is held for more than 1 year. That's the general idea of what PP is all about, tangible item. Beyond that, you need to appreciate recognition criteria of PPE. And if you remember, when we talk about the recognition criteria of PPE, we mentioned 2. That number 1 is this probable that what? That future
economic benefits
will what?
We
will be
arise
derived of it.
Okay. Due to the entity. And what's number 2? It must
have a contract must be measurable, I think.
If it is must have a standard.
Yeah.
Measure reliably.
Reliably. Okay. So, I mean, they can ask you this also in the exam. Another one was, we mentioned measurements, and under measurement, we talked about initial measurements. That
subsequent.
Before subsequent, we learned that item of PPE are initially measured at what? At cost.
At cost.
Okay, so under these initial measurements, you can find the examiner asking you the components of costs. And what are the components of cost that we can have?
We can have purchase price plus all import duties,
installation cost,
plus
unrefundable amounts,
plus, and what? Plus you have a purchase price.
unrefundable purchase. Is it unrefundable amounts of purchase time?
Okay.
Purchase price, import duty, professional charge, professional charge, or
unrefundable purchase tax.
Okay, it's not refundable. No.
non-refundable.
Purchase tax.
And we less our trade discount.
Yeah. Pay discount and what?
Then
Rebate. Then
Dismantling costs.
before that we have
Directly attributed when bringing the item, the asset.
Yeah. So which are the costs of bringing the assets to its location and condition? So what are the directly attributable costs we mentioned?
We have installation,
Installation,
handling costs, assembly,
initial delivery,
that's transportation.
yes, and handling costs. Installation, as assembly and installation usually go hand in hand. So initial delivery and handling costs. We have site preparation costs. We have employee benefits that are directly involved in
construction,
yes, in getting the asset ready. What again?
testing,
Yeah, the testing costs.
But the
Let's
testing cost will be
do you remember this?
each of them.
Testing
Testing cost,
let's sales proceeds
proceed
from
from
sales
sales of
proceeds.
something.
Okay, is there any other one that I've not mentioned? Directly attributable cost.
Dismantling costs.
Sir,
No,
don't worry.
I'm talking about directly attributable costs. Is there anyone I've not mentioned?
Okay.
Professional fees.
Thank you. Professional fees.
mentioned that.
Professional fees, yes. Okay, so these are directly attributable costs. Now, after directly attributable costs, then we have dismantling, or let me call it
Remover,
The commission.
the commissioning costs, which is the cost of removal, dismantling, and what? Restoring the site to its original what?
Original status.
Original condition. Now, and if you remember, I told you that this decommissioning cost is a future cost.
It's a future cost, yes.
And when you want to determine your cost of PPE now, you need to discount it to present value. Do you remember?
yes.
Okay, good. So aside these three, is there any other component of cost that we have not mentioned?
We have borrowing cost.
Thank you very much. Borrowing costs, which is the cost of the interest to pay when you borrow to buy a qualifying,
The asset.
The construction of the asset, yeah. Purchase price, the commissioning.
Okay. Now, that's measurement. Another one that is still under measurement is they can ask you in the exam that you should list the costs that are not directly attributable to the initial cost. So can you tell me the costs that are not directly attributable? No, we have mentioned this one, the costs that are directly attributable. Abi, I've seen a question before that they ask you, according to IAS 16, you should list the costs that are not directly attributable.
We have training costs.
That's correct.
The cost of moving labor, how would I put it?
Okay, relocation cost. That's also
Staff training costs.
okay. I think we have mentioned that. We have mentioned training cost. Any other one?
Administrative.
General overhead cost.
Thank you very much. Thank you very much. Administrative and general overhead.
No.
Which one again?
Research and development. I think that one mostly is that one in PM. I don't know if it's
What about
Yeah.
advertisements, sir?
Yes, I will take that. I will take that. Advertisements. How about the cost of opening?
So I said
Your
research and
personal.
development. Can it be part?
What's it?
Research and development. Can it be part?
Research and development. Don't put it. It's not mentioned. It's
Okay.
to put all the other ones. Pre-operational what? Expenses. Okay, fine. So, and if you can remember 4 in the exam, just look at it very well. Just remember 4 in case they ask it in the exam. Okay, so these are initial measurements.
What's that? That should be
And we learned about subsequent measurements. So what's the subsequent measurement that we have?
cost model and evaluation.
Cost model and evaluation model.
Evaluation model.
An evaluation model. And what's the cost model?
Cost model is
Cost
cost
minus
minus
accumulated
accumulated depreciation
depreciation,
minus
accumulated amortization.
amortization.
No, depreciation, impairment loss.
Impairment loss.
Accumulated impairment loss.
Okay. What about this one?
And it give us our carrying amount.
Fair value.
Okay.
Fair value
Subsequent
minus
accumulated
subsequent
depreciation,
accumulated depreciation
less
minus
accumulated
subsequent
impairment.
accumulated impairment losses.
relocation
So
cost,
one as
Sorry?
administrative.
Okay. So these are subsequent measurements. Under these subsequent measurements, if you remember, that was when we learned
Depreciation.
depreciation. And depreciation, we said, is the systematic allocation
Allocation of costs.
costs or depreciable amount of an asset over
the
estimated useful life.
useful life.
So from here now, can you tell me what's depreciable amount?
depreciable amount
Is the carrying amount?
No.
Depreciable
is
amount is the cost minus residual value.
Thank you. Cost minus
Residual value.
cost minus residual value.
Depreciable amount.
That's depreciable amount. Now,
Okay.
what's useful life?
Useful life is the
Expected period now to use the asset.
estimated
Number
life
of
the asset.
estimated life.
Is the estimated life of the asset.
Number of estimated economic life of the asset.
The asset.
Good. So what are the factors that determine the useful life?
Level of usage of the
Obsolescence.
asset.
Obsolescence.
What do you call it?
Level of usage of the asset.
Yes. Talked about that.
Obsolescence.
We'll talk about technology advancements.
Okay.
Maintenance culture.
That's correct. What again?
We have legal limitation or restrictions.
That's correct. That's our auto. Okay. So what about the depreciation methods?
Straight line method
Straight line
and
Reducing balance.
reducing balance
And
method.
reducing balance method.
So how do we get straight line method? How do you get depreciation for straight line method?
Cost minus residual value.
So
Divided by
value,
the
followed by
useful
useful life.
divided by the estimated useful life.
Depreciable amount divided by useful life.
Okay. What about the reducing balance method? How do you calculate depreciation there?
Depreciation rates
Carrying cost.
multiplied by the carrying cost.
We use carrying cost.
Okay. So basically, these were what we learned for depreciation. Then we move to revaluation. Now, for revaluation, the first thing I always ask you to determine is for you to identify when is the date of revaluation. So from the date of revaluation,
Depreciation rate.
from the date of revaluation, then you determine revaluation surplus
Surplus
Or deficits.
or
or
deficit.
deficit.
And to determine your revaluation surplus or deficit, you compare
Revalue
the
amount.
value
Value amount
with the
with
what?
carrying amount.
With the
Carrying
carrying
amount.
Carrying amount.
rate. So
Yes.
usually when you have a revaluation surplus, you debit the asset
Asset.
and what?
With credit
And credit revaluation account.
OCI.
OCI with what? With the revaluation.
With the amount of revaluation. Yes, amount of
Loss.
revaluation.
But if there was a previous
Loss.
revaluation
Revaluation.
deficit,
Mm.
how do you deal with that?
We use the surplus to
We
reduce
use the surplus to
the
offset to reduce
So that means you debit POL.
and then
No, you will not debit POL. You take it to, you credit POL first to get off the
Yes, because
surplus. Then you credit OCI
credit OCI, then you debit assets.
and debit the assets. Okay, fantastic. So basically that was, and we solved some other questions on it, but that's the core principles around revaluation. Then we looked at disposal of assets.
Disposal of assets.
And I told you that when you dispose an asset, the core thing is for you to determine the profit or loss
On the assets.
on disposal.
Mhm.
This is very important. And how do you determine the profit or loss on disposals? Is the sales proceeds minus what?
Minus the carrying
amount.
amount.
And the carrying amount.
And where do you do this? You do this, which account helps you determine your profit or loss or disposal?
Account.
There's an account that
What
will
me put your
prepare.
question, sir?
Which account helps us determine our profit or loss on disposal?
is it not asset disposal account?
That's correct. That's correct.
Some disposal account.
So you determine it through your disposal account. Okay, so let me not bore you with the debit and credit for that disposal account because they hardly ask it in your exam. So they hardly ask it in the exam. Now, another one they can ask in the exam is disclosure requirements for IAS 16. At least you should be able to know 4 disclosure requirements for IAS 16.
Method of depreciation.
Okay, that's correct. Depreciation methods.
Depreciation rates.
That's also correct. Depreciation.
Cancellation of opening and closing. Okay, opening and closing balances. Carrying amount. Okay.
Any other one?
Depreciation.
Association with reconciliation of
Useful, yeah,
land.
useful life of the assets.
John again.
Residual value. Wow.
Okay. So, I mean, you should be familiar with all of this. Just give them these 5 in the exam in case the examiner, there are much more. I mean, if you have impairment on that asset, disclose. If you have evaluation, how did you get your fair value, and a lot of other ones like that. Okay, so these are the salient things in IAS 16, and which I can see that you're very, very familiar with. So we move on to intangible assets. I don't see them asking you definition of intangible assets. But can anybody remember the definition of intangible assets?
Yes, they are non-monetary. They are non-monetary.
Asset without physical substance.
Identifiable non-monetary. Somebody forgetting this
Without physical substance.
house physical substance.
Well, even if you forget,
Non-identifiable assets.
I don't see them asking you define an intangible asset. I don't really see them asking you that. So identifiable non-monetary assets without physical substance. If you remember, I explained to you that identifiable means that the asset must be separable. Okay, something you can sell separately, and it must, and also it can also arise from legal or contractual rights. Okay. That was where we gave example of a patent, goodwill,
Brand,
yeah, you have copyrights,
copyright.
and I say that non-monetary assets are assets that the money the return from them varies. It's not fixed, unlike monetary assets that is fixed and is without physical substance. Okay. And I told you that the recognition criteria, if you remember in class, recognition
I'm sure
criteria,
I same with IAS system.
exactly.
Cost
I
will
would
be
have quite
measured
remember on that.
reliably. It must be provable that there will be economic benefits.
Yeah. So that's why in the exam, you will not see them asking you recognition and measurement for IAS 38 because they will rather ask it in IAS 16. So because it's just the same thing. It's the same thing. So now, aside all of this, the interesting part is this. For measurements, right? If the asset is an internally generated intangible asset, how is it measured?
We measure it at fair value.
Okay, measure it at fair value. Okay,
Yes.
any
I
other
thought,
trial?
Cannot measure
that
it.
one cannot be
You
recognized.
cannot
Okay.
measure internally generated asset
Yes,
though.
it cannot be recognized in the book.
Thank you.
Yes, now you cannot measure internally.
They cannot be measured.
They are
Cannot be.
not
It
measurable.
is
They are not
Internally
measurable.
generated cannot be measured,
Okay.
Yes.
not be
Okay.
reliably measured. Yes.
Okay. They are not, okay, yes, they cannot be reliably measured.
Internally, yes.
Okay, that's correct. That's correct. Okay, good. Good, you still remember that. Now, another one that is key, you find them asking you here is there are some internally generated intangible assets called research and
Development.
for research, I told you they are expensed,
Yes.
but development can be capitalized. Abi?
Yes.
Yes.
Can you
So
Yes, sir.
they can ask you conditions for capitalization of development costs. I think we saw something on research and development yesterday. So
Yes.
ICAN can ask you for 5 or 6 marks that what are the conditions for capitalization of development costs? Do you remember the mnemonics I gave you?
Yeah, pirate.
Yes.
Pirate.
Good. Fantastic. So with this
It's
one,
economic
we'll be
benefit.
able to
So it
help.
must be
Probable
probable.
economic benefits.
Okay, that's
For
B.
economic
What about I?
benefit.
Reliably.
There must be intention to
Intention
sell,
to complete the project.
to complete
Thank
the
you very
project.
much. Intention to complete. What about
Resources must be available
resources
to complete
available?
it.
What about A?
Ability to use or
sell,
sell them.
use or sell the assets.
Thank you. What about T?
Technology must be
Technological
available to
feasibility.
complete the
Okay.
assets.
It's technological feasible. What about E?
The expense must be
Expenses
reliably
of the
measured.
project.
Okay, expense can be identified on
Okay.
identified. Okay, yeah, fantastic. Okay,
Please, can you come again, one after the other? Let's say it clearly before. Thank you.
I don't understand. You don't get it.
okay. So the first one is probable that it can be measured.
Wasn't necessary.
It's probable that it can be measured reliably. The I is intention to complete and sell. That's the I. Intention to complete and sell. The R is resources are available to complete the project. The A is ability to use it and also to sell it. And T is technologically feasible to complete. And E is expenses can be identified on the intangible assets. Okay, that's pirate for this. Okay, so they can ask you this in your exams. So let's mention something. Okay. So remember, I told you in class that in publish account in your question 1, how would you know that all these 6 exist? You know, I summarized it to you that these 6 can translate to either board approval or regulatory
Approval.
approval, right? Like there was a date, I think yesterday, we saw that it was when the board saw that this thing is profitable. It is from that date we started capitalizing those costs. Okay. So, and also have in mind that disclosures here is similar to that of PPE.
Yeah.
Disclosures here is similar to that of PPE. Now, when I was done with this, I moved to, let me just move randomly. Let's look at IFRS 16 on leases. IFRS 16 on leases. Now, the first thing here is this, okay? In a lease arrangement, we usually have the landlord, the lessor, and lessee. Now, usually, for you to identify a lease, there must be transfer. In fact, there must be, you will see that the tenant, who is not the owner of the asset, he will have something that we call right to what?
Right to use assets.
Right to control.
Right to control. The lessee will have right to control. And what does right to control means? It means 2 things. Can you remember?
Yes.
I can direct the use of the assets.
Okay. Can direct the use of the assets. What again?
And all the economic benefits would flow to the lessee.
Okay. He obtains substantially all the economic benefit. Fantastic. I mean, you just, as soon as you mention all of this, nobody is saying you have to write it in a particular way. they know what they are looking for, and you definitely get your mark. So this is how, in a lease arrangement, we look out for right to control. As soon as it's present,
Control.
yes, that's the main thing
The
there.
use of
As soon as the lessee can direct
assets.
the use of the
Obtain
assets,
substantially all economic benefits.
yes, and it can obtain substantially all the economic benefits. That means there is a lease arrangement there. Now, and I told you about let's go to the accounting straight on. Accounting for leases. Accounting for leases, accounting for lessee, for the lessee. You see, if you remember, for the lessee, I told you that from inception dates, the lessee will recognize a right of use assets. Right of use assets. And what?
Liability.
Lease liability.
Lease liability. And I told you that the lease liability is how much the lessee is owing over the lease term, and is measured at the present value of what?
Unpaid lease.
Is measured at the present value of unpaid lease rentals. Present value of the unpaid lease rentals. And how does it measure the right of use asset? The same way it measures the right of use assets, the lease liability, but it's going to add the amount paid at when?
Commencement.
At commencement dates. And also, if there are any initial direct costs,
Legal cost, initial cost.
you will add that too. And if you have dismantling costs, you will also add that. So that's how lease liability or right of use asset are measured at the inception dates. So these like measurements at the inception dates. So how does he measure them? At the end of the year.
I think it will be cost minus lease term.
Starting with lease liability. How does the lessee measures the lease liability at the end of the year? Who can tell me this?
I think it's cost minus lease term.
You have to unwind, you bring your balance book forward. I think you unwind the discount less
Okay.
what you have paid, and then you have your balance carried down.
Okay, you have your balance book forward.
Unwind discount, which is in finance cost. So yeah.
Then what?
Lease rental, you less it.
At the beginning.
And I give you your what?
But I think this one is for when the payment is made at the end of the year, right? Because I think the one when the payment is made at the beginning is different.
Exactly. It's like you would lease rentals will come first. Okay. So if the payment is made in arrears, if the lease rental is paid in arrears, it will be financed. This finance cost to be calculated on the opening. Okay. But if the lease rentals is paid in advance, to look like something like this, balance go forward. Because the lease rental being paid in advance means that it's paid at the beginning of the year. And usually interest is calculated at the end. So that's why we need to remove the lease rentals first.
Mr.
So
Wasu, I'm so sorry to draw you back. Please, this thing, can you please make a scenario with figures? Again, sorry, sir.
okay. Yeah, I can feel the quietness when we got to IFRS 16. What's happening? We didn't revise it or what? Maybe they were just
It's
quiet.
so,
That
so
thing is
complex.
confusing, but I said that I don't feel so many
It's so
questions on that
complex.
list.
Well, what did you say?
I say it's so complex. I've even read it. I read it over and over again. But it's
Imagine
just
when we even saw that list in published accounts, Pelumi. You remember that one?
yeah, it's a bit on the complex side.
It's easier why you're finding
Dodge
it
it.
from.
We
It
shall
was
dodge it.
actually hard, but you can check the YouTube, Mr. Wasi's YouTube. It's very explanatory. Go back on it. You will
Let him do
understand.
it now in class. I beg.
Yes, you can also do that.
If not, we shall dodge it.
Because I don't want to see it to as compulsory. I will cry.
But they can ask it, you can dodge it if it's section B or section C.
Exactly, but to bá compulsory
It's not, but we solved that one unpublished in class, and you still did not understand that. That's strange. So usually in questions, you find the examiner. I mean, it has different variations. That's one of it. You can find the examiner giving you that. Of course, a lessee must have rented an asset and all of that. So do you see the examiner giving you the PV of lease rentals? Okay, they can give you the PV of lease rentals as, let's say, 250,000.
Okay.
Okay. Then you also catch them giving you the lease rentals per annum. Let's say this is 45,000. You catch them giving you the lease term. Let's say this is 5 years. You catch them giving you the yeah. So basically, these are the key variables. Yeah, they'll give you the interest rates. They usually call it interest rates implicit in the lease. Let's assume this is 10%. Okay. So, and if they don't give you this, if they don't give you the PV of lease rentals, that means you'd have to calculate it yourself. And let's assume they didn't give us. How would you have calculated it?
They would have given us the amount payable per year, and then we just do the annuity factor times the amount payable per year.
Okay, that's correct.
We
So
do
you
what, sir? Please come
the
again, Pelu.
annuity, you will
Like
have,
they'll give you the amount payable per year. For example,
Okay.
let's say it's 100 million every year, and then you
Okay.
have 5 years that is left unpaid. So you calculate your annuity factor with
Annuity.
maybe 5 years, and then whatever you get
Okay.
to multiply it times what is payable every year. That will
So that
give
will
you your
give us the
present
PV.
value.
so
That
in
is
this now, in this scenario that I'm painting now, what's is payable every year? What's the lease rentals every year? Is this 45,000?
45.
45, yes.
But we find out that in most questions, you see them giving you, they would mostly give you these
PV.
lease rentals every year. They'll give
Okay.
you. So, and they will always tell you whether the lease rental is paid at the beginning or
Exactly.
at the end. They always tell you, let's say it's at the end, you will always mostly find it at the end.
Finance costs.
So in that case now, what
10%,
you need to do is
25.
just
Please, let's hear him.
anytime you see leases, these are the key variables you find. And for lessee, all you need to do is the lease liability and the right of use assets. For the lease liability, what's the opening value? 250. Abi? What's the
Okay.
finance cost here? It's just 10%
That's
of
10%.
10% of 45,000.
which is how
Okay.
much? 25. What's the lease rent house? 45.
45,000.
What's the balance?
The finance cost is 10% of the 250, Abi.
Which
The
one are you talking
finance
about?
cost.
Oh, yes.
180.
180.
180,000.
So now, what goes to P&L here?
Finance cost.
What goes to your statement of financial position here?
Balance. Balance brought forward.
But you know that you need to split this 180 into current
Total.
and non-current. Do you remember that? So how do you split this 180 into current and non-current?
You have to do for the following year.
Yes.
The
You have to
balance.
for the
Oh,
following
yes,
year.
yes, I remember.
So for the following year now, what's the finance cost?
Finance cost for the following year
18.
will be 0.
So
Okay,
Remember that
10%.
one.
what's the lease rent house?
45.
45. So 180 minus 80.
Yes.
What's the balance?
117.
So now we have done the following year, Pelumi.
Yeah,
So
so 117 will go to current, non-current, and the difference between the 180 and 117 is what goes to current.
Current, yes, affinity.
Please come again.
That's it. So now
Please
that we
come
have done the
again.
second
Oh.
year, okay, now that we have done the second year, 117 is what goes to our non-current liability in year one, while the
Okay.
difference between 180 and 117 goes to current liability.
Okay.
So for the lease liability is no more than that. So I'm surprised I'm just hearing that it's complex. What's complex there? It's not actually complex.
Yeah.
No, it's when you are doing it that looks like, okay, it is, but the moment you are left alone with it, it's, I don't know.
So our current year start with that finance cost that be that 18,000. Our second year.
No, second year is the balance, but the balance closed down for the
This
first
one
years. You're
will
opening for the second
For
year.
the second year, okay. Second year.
So for the right of use asset now, it will still be the PV of unpaid lease rental.
So what is
Is
it?
that much?
250.
And you calculate your depreciation per annum.
That's 250.
Which is how much?
250 divided by 5.
50,000.
And this goes to where?
Yeah.
Yeah.
And this goes to where?
But
No, it's the carrying amounts that will go
current
to non-current assets.
non-current asset.
Yeah.
Oh, I think we don't. Do we usually split right use to?
No, we don't.
Oh, okay. God, please.
So this is basically it for the lessee accounting. So at least know this one at the very basic level. So you might not necessarily worry yourself again because the exam is tomorrow or next tomorrow. I mean, there's no difference anymore. So at least everybody should be able to relate with this. I can actually come back again if you still don't get this one. I just want you to have this idea. If for anything, be able to do this liability and right of use asset. And this 180, be able to separate it into current and non-current. Should be able to separate it. And like we have done, that means you have to do the next year. So when you do the next year, so the next year balance is what goes to non-current liability as the lease liability, Why the difference between that 180 and the next year balance? This is what goes to our current. Okay, Cynthia, you can ask your question, please.
Okay, I want to ask, I was trying to have a question on this, and if we're not giving the TV of this rental, we're trying to like find it ourselves. If the money was paid at commencement, like what do we use at the number of years? Maybe we choose the number of years we want. That's my question.
Okay, yes. I heard what Cynthia said. So Cynthia said that if, for example, now they told us that the lease rentals is paid at the beginning of every year, okay, and they gave us the lease term as 5 years, and they didn't give us this, and we want to compute it ourselves. How do we do it? So she said that
So,
discounting. Yeah, go ahead, please.
okay, so the discounting factor is going to be annuity, but it's going to be 4 years. And then when you are it's going to be 4 years, that's going to be your present value is going to be calculated on the 4 years that is left. And when you are going to do your measurement, you start with the balance brought forward, but then you had the lease rental you've paid. That's where you do your finance cost on. Goodness me, it's confusing. But I now have to calculate the right of use. I know the right of use is going to be the PV of the unpaid plus the one you've paid already. That's what is going to give you your right of use. But
measurement should be balance brought forward, then minus your finance cost. There's no lease rental for that particular name. That's paid in advance.
TV in the beginning, minus the amount that is paid already.
Okay, thank you, Cynthia, for asking this question. Let me just quickly show you this one also, so let's assume this, they didn't give us this, and this lease rental is paid at the beginning. Yeah, so your lease liability at commencement will simply be the PV of unpaid lease rental, which is 1 minus 1 plus R raised to power
minus N.
minus 4.
Minus
Okay.
N. Is writing
Yeah.
formula first.
over
R.
over R.
Okay, the bar is carrying everything.
Yes.
That's what is.
So in this case now, is like that would be 1
minus
1.1, Abi?
Yes.
Yeah.
Raised by minus 4.
Minus 4. But wait, why are we using -4 instead of -5?
Because we paid
because
for
we paid
1 year now. We've paid at the beginning. We've paid for the first year at the beginning. So what we have left is 4 years.
Fantastic. Good. So what's our R.1?
Equals to 3.169 or maybe 3.167 approximately.
Okay.
Sorry, 169. No, 169. Sorry. Yeah, good.
So then you multiply this by what?
No, by 45.
Okay, 45. Okay. So what do we have?
$142,644.
Okay, good. So now at the end, the lease liability will look like this. We'll have balance go forward, which is how much?
142,644.
We'll have lease rentals, which is how much?
45.
45.
Pelumi, what would be our lease rental?
45.
In year one,
0.
thank you.
Year
Zero.
one, we've paid year one already now, so we won't pay anything again.
Exactly. It should be 0.
Okay, we are starting from year 1 again, not even year 2.
Why do you want to start from year 2, Adiago?
I thought because we've already paid year 1, we just
But you need to get the value of your liability in year 1 and your finance cost in year 1.
okay.
So what will be our finance cost? That will be
10%.
14,264.
Mm-hmm.
Yes.
Okay. So what will be our balance carry forward? How much?
128. I'm coming 142,644 minus
I
1
don't
4
want your plus.
128,379.6.
128,318.
Again,
We are not minus, we're not supposed to add it together.
we are supposed to add it though.
We're not minusing.
So how much do we have?
142,644.
156,908.
9.
156,9.
156. 156.
908.
Okay. So it is in year 2. When you're not doing year 2, this will be 156,908.
We
Then
always add our finance cost.
No,
you
you
now
deduct your lease rental first, and then you do the finance cost on the balance.
so that
I'm thinking
I
something
would
else.
need to get the balance. So what's the balance here?
111,908.
111,908.
So what will now be my finance cost now?
119. 119.
No.
What will be the addition?
123,098.8.
123,099.
Okay, let me do
123,099.
09.
Yeah.
Let me do one here. 123,099.
Down on my knees.
7809.
78099. 780.
85,908.9.
9 what?
908.9 or 909.
Okay, good. Let me stop here. Good. So the right of use assets will simply be the PV of unpaid lease rentals. In year 1, how much is it?
14644.
You add amount paid at when?
At commencement.
Which is how much?
45.
So what's the addition?
187.
187,644.
So what's my depreciation per annum now?
Divided by 5.
1876.
187,644 divided by 5.
How much is that?
37.
37,529.
529.
Yes.
Yeah.
Okay. So this is all. So in your SOPL, you have your finance costs in year 1 that will go to P&L, which is 14,264.
For depreciation,
You have your depreciation,
37,529.
529. And your statement of financial position under your
Non-current liabilities.
current assets, you have your right of
Okay,
use
right of
assets,
use.
which will
Right
be
of use.
the costs. How much is the cost?
0.7
minus depreciation.
minus accumulated depreciation.
So what do we have?
Right.
We have 150,155. 115.
50115.
My liabilities, I will have non-current liabilities.
Non-current liabilities.
So in year one, how much is my non-current liability?
To be the difference between 156.
No, 156. 156.
Minus
12309.
123.
156.
Minus 123.
099.
099.
No.
No.
We have
That's
is
different between
123,099.
minus 85909.
No, that's current liability.
Current liability.
That's current liability. I think it
So
will be
it's
123.
156,908.
It's going to be
It's going to
123,099.
be 123,099.
It's going to be
Then the next one will
123,099.
be the
Difference between
then the next one will be the
156,908
difference
minus
between
123,099.
no current liability will be 123,099 minus 85909.
Okay.
33,809.
That's it. So, I mean, just just try and understand this one. And this splits, I can see that you're still finding even this split confusing for some of you. So is the second year balance that would come in as your non-current liabilities.
The second year balance.
Yes, the second year balance that
Okay.
will come as your non-current liabilities. Why the difference between these
Okay.
two is the current. Of course, when you add these two together, the current and the non-current, you will get this your 15690. 908. That's what you are actually splitting. So that's what you're actually splitting between current and non-current.
Sir, please, can you scroll up like to the beginning of it, everything? Like to the beginning of when we started. Okay, yes, this is fine. Can you scroll up again? Like towards the end.
I'm actually going to share this with you.
Evidence go check out.
Yes. Sir, please, can you still go up again?
You know, I'm still
He's
going
going
to
to share the PDF.
He's going to share us the PDF now.
Before I will go and open PDF. Yes.
You don't believe him.
Just want to be shakam. Any small thing, shakam.
Okay. So that's for this one. That's for let's see. You need to try.
Thank you, sir.
You need to try and understand this one. You need to have an idea. At least this for in the exam, what we find them is let's see. And this scenario I've just painted for you now, if you can know this, is not more than this. Even the one they asked in published last year or last diet, which is last year anyways, it's not more than this. It's not more than this. Just look through this and it's something you should know. IFRS 16 is actually easy for you guys. So, however, for the lessor is also similar, just that for the lessor, what he does best is he would recognize that asset from his books, and the lessor will recognize, what does he recognize? A net investment in the lease. However, what I think starts with is that for the lessor, he needs to understand whether he's having a finance lease
or an operating lease.
Yeah, so you can either have a finance lease or operating lease. So who can really tell us the indicators of a finance lease?
Okay, so for finance lease, you find out that the useful life of the asset is always like the lease term. Also, all the risk has been and benefit has been transferred to the lessee.
No. This
Abi?
first is correct. The useful life is almost equal to
Useful
the
life.
lease term. So what's second indicator?
There's a
I said
purchase
that
There is no
option.
if
transfer.
the wait, for finance lease, there's no transfer of risk and reward.
That's the meaning of finance lease. Finance lease means that the lessor has transferred substantial risk and reward.
So
That's
it's not like an indicator.
no. So what shows that we have transferred risk and reward? That's
If
what
there's
they
an option to buy,
There's a purchase option.
okay, yeah. Okay.
and then
Is
the
This one that
present
you explained
value,
that is only the
the present value of
let's say
the lease is
can
like the
use it.
market value.
I don't know.
if there's any loss on cancellation,
That one is secondary. I mean, they won't give you my product.
Okay, and the present value of the lease is equal to fair value. Yes.
What again?
There was one that you mentioned that
So that if the machine is for
that
if the asset is for that purpose alone, that cannot be used
that that's what
for
I use it
something
for.
else.
That you were explaining boss and Korope. There was a way you put that line.
If the asset is specialized in nature.
In nature. Okay.
Anyone again?
If there's a purchase option, then that means if there's going
There's
to
a
be like
purchase
a
option.
transfer of ownership, if there's going to be a transfer of ownership at the end.
If the asset
When the lease renter is
Yes.
subtracted to the market value,
Oh, that
is
one
equal to
is
the market value. Okay, we've done that one. Equal to the list term, there's purchase option, depending on the is almost equal to the fair value. Yeah.
okay. Good. So these are the indicators of finance lease. They can ask this in section C or anywhere. Okay. So when you have a finance lease, the way it's recognized first is that you would the lessor will recognize a net investment in the lease. And when we see net investment in the lease, is similar to lease receivable. It's the same thing as lease receivable. And how do you determine net investment in the lease?
And the PV of unpaid rentals is there, and then the amount of the unguaranteed residual value. Okay, PV of unguaranteed residual value.
Just need dish.
Okay. So, this revision is on the assumption that you have read. And if I see somebody, if I'm doing a revision like this with somebody, I'll just be shaking my head. Okay, yes. I mean, it should not be sinking that, okay, since assume that you have actually read most of these things. Okay. So don't forget, they are both PV. And you should be able to figure out this unguaranteed residual value, because the examiner will paint a scenario for you that the lessee guaranteed the lessor 10,000, but the lessor thinks you can sell it for 11,000. So that difference,
It's unguaranteed.
yes, of 1,000 is the unguaranteed. And don't just put that 1,000 like that there. You have to get the present value of that. You have to get the present value of that unguaranteed. So by the time you get this is the inception value. This is the value you get first at the beginning, at the inception of the lease. You see, at the end of the lease, sorry, at the end of the year, similar to what the lessee does, we'll do balance brought forward. You do finance income. You do lease rentals. Then you get balance carried forward. And that's all it does. That's all this guy does. And this one will come in as net investment in the lease as a non-current asset. And that's really it for the lessor. That's really it for the lessor. And if you remember, for operating lease, I told you that the annual rentals is recognized to P&L on a straight line basis. That's all we do here for operating lease. The annual rental is recognized to P&L on a straight line basis. So you'll find the examiner, they will tell you something like, we leased a machinery to a third party and the guy is supposed to pay us 50,000 naira per annum, but we are giving the guy 6 months rent free. 6 months rent free. So the solution to that is just to find how much collecting over the lease term. How much are you receiving over the lease term? Divide that by the lease term. Divide that equally. I mean, there is an annual rentals of 50,000 and the lease term is 5 years and there is an incentive of 6 months rent free. So, and the principle for operating this is that the rent must be recognized to P&L on a straight line basis. A straight line basis. So when this guy is paying 50K every year, over 5 years, but we are now saying in the first year, don't pay entire 50,000, pay 25,000. That's what we mean by 6 months rent free. So that means in first year, we will collect 20,000, 25. And between the second to the 5th year, we'll collect our normal 50,000 times 4. So we'll collect 200,000. So the amount receivable over the 5 years is simply 225,000. So the amount recognized to P&L every year will now be this 225 divided by 5. If you press your calculator, what would that give you?
225.
45.
45,000. And this is what goes to P&L. But if you recognize just this to P&L and do nothing, you'll be wrong.
Yeah.
Because there will be a fallout. There will be a receivable at the end of the year. Because if you look at it, we'll have like a lease receivable. Because at the beginning, it was 0. we recognize how much to P&L,
45.
but how much did you
But we
receive?
received 25.
So there will be a balance that you put
Yes.
a non-current asset of 20,000 in your book. Okay, so this is everything on IFRS 16 that I really taught you. Is that right?
So please come again with this 45,000.
This one?
Yes.
Okay. So to get how much you recognized over every year as lease rentals to P&L, is just the actual amount you receive, which is 225,000, divided by the lease term, which is 5 years. Then that gives you 45,000. And is this 45,000 you recognize every year? But for the fact that in year one, you only received 25 and you are recognizing 45 to P&L. So there is a receivable of 20 that you also need to recognize in statement of financial position as a non-current asset. You need to recognize this in the statement of financial position.
Hello, sir.
Yes, Mary.
Sir, please, I'm confused about this leasing book. So you said when the amount is paid at commencement, that for lease liability, what we are going to do is PV of lease rental, then we deduct lease rental, then after deducting the balance, we now do finance cost on it. That's when the amount is paid at commencement. Then you
Yes.
now did another one. Is that one that now confuse me? I no understand. You
Which?
did not, you put dash for the lease rental.
Oh, okay.
No, you've passed there.
Okay, so this one.
Around this, yes, around this lease rental is dash.
Okay. Okay. The reason why I put dash is because in year one, we have already paid these lease rentals in year one. It has been paid already. And if you remember, this 142 you are seeing here as liability does not even include the year one figure, which is why the lease term was 5 years. But when we were discounting, we only discounted by 4 years, saying that we only owe 4 years rent. We have paid the first 45,000 immediately. We don't owe that anymore because it will have been settled. So our liability is based on the remaining 4 years. So which gave rise to this 142. So when we're trying to get how much we are owing at the end, this 142 already excludes the lease rental paid in year one. So that's why it's 0, because it has been paid. We don't owe it. Okay, the whole idea of this schedule is that, okay, how much do we owe at the beginning? Deduct how much we are paying from what we are owing. From in year one, this amount is after we have settled what we are owing in year one. So that's why this lease rental here is 0. Then finance cost will be applied on the balance here. Now, in year two, this balance that we carry to the next year, okay, this is what we are owing. In year two, we now paid 45,000 at the beginning. Now we can now remove that, okay, because we are owing that, and the system continues like that. But you see, in year one, at every point in time, when lease rentals are paid in advance, this is how you would always do it, because these amounts will not include the year one liability, because it will not include the year one rent, because that has been settled. We are not owing it. It has been settled because it's paid immediately. So this you will not, there's no point putting it as a liability here because we are not owing it. So the lease rental will just be zero. We just put it as a placeholder there, zero. Then we'll go on like that. I don't know if that helped.
All right, sir. Thank you.
Okay. Okay. I don't know why you're finding this difficult. I really don't. So that's the end for leases anyways. So let's just try and revise it step by step. Even if it's this one you're able to use or that last diet published question, just have an idea of it. Because you might find it there. So let me go to the one, your voice will not be loud now. Impairment of assets. So for impairment of assets, you need to check that your recoverable amount is higher than your carrying amount. That's a major thing here. So if you have a situation where your carrying amount is higher than your recoverable amount, it means that you are overstating your assets. It means that you are overvaluing your assets. You need to bring it down. You need to write it down. And recoverable amount is the higher between the net realizable value of the asset
Value and
and
value in use. Value in
value.
use.
Okay. Why, of course, this is simply your cost minus what?
Accumulated
depreciation.
Okay. So you see the difference between these two, if you have a recoverable amount of 50 and you have a carrying amount of 40 of 75, that means there is an impairment
Yes.
of 25.
25.
And this impairment simply goes to where?
Yeah.
But let's say there was a previous revaluation surplus of 20. So how do we deal with this 25? Who can tell me? I need just one person. I don't want people talking at the same time. How do we deal with this impairment loss of 25?
20 will go to OCI.
No. We'll
Let her finish before you one after the other. Okay, go ahead, please.
Since we're having impairment loss of 25, and 20 out of it, we are going to clear it with the surplus that is in OCI. Then 5 will go to POL.
Yeah, that's correct. So this 25, 20 will go to OCI because there was a previous evaluation surplus.
Of
While
20.
the 25 go to where? POL.
Yeah.
That's absolutely correct. Okay, good. Now, don't forget that before we even get to this stage at all, you need to be able to know indicators of impairments. And I told you that there are external indicators and there are internal indicators. Okay, so let's see if we can recall, let's say 3 each. So what are the external indicators that we have? One after the other. Don't talk at the same time, please.
When there's a technological change in technological environment,
Technology,
economical,
economy, and what?
and legal environment.
Legal environment in which the asset operates. Okay, that's one. I need two more.
When
there
there
is
is a
an
fall in the
increase,
market value of the asset.
When there is a decline in the market value of the assets. That's correct. One more.
when there is increase in the interest rate that is used to determine the value of the asset, the value in use of the asset.
When the carrying amount.
Yeah, see it.
When the carrying amount of the entity net assets is more than the market capitalization.
We are here.
Higher than the
Okay. What about the internal indicators?
When there's a physical damage,
The asset.
Okay. Which one again?
Decline in
when,
productivity.
when there's a huge decline in the productivity,
when there is reduction.
What again?
When
and
there is
when
reduction.
the useful life of the asset changes adversely.
Okay.
It's reduced.
As a change or as an adverse change.
Okay, what again? Aside that.
No.
Okay, fine. Okay, I think you have done very well. Okay, and you know that these indicators of impairment is also called impairment review. In case you see the examiner,
Impairment review.
you carry out impairment review.
So
So
we say internal review and external review.
you can still say internal indicators and external indicators. So
Okay.
okay, yeah. So while impairment tests, if you remember, is where you determine recoverable amounts and the carrying amount, and where you actually determine impairment loss. Okay, good. Now, after I've taught you all of that, I now went to cash generating units. Remember? Okay. Who can define?
We say there is a small group of identifiable assets that generate cash flow dependently of each other. I mean, is it
Smallest identifiable group of assets that generates cash flows
independent of other assets?
largely independent of other assets. Yeah, that's correct. That's a CGU. So why do you remember why I said we use CGU? What's the importance of CGU? In fact, the way I said it in class was that CGU has a singular purpose in this life. What's the singular purpose in this life?
Is it to check the impairment of other assets that do not really generate cash flow, but they are vital to the operation of the business? Is it? I think you're using AC, fan, furniture to explain it that day.
Yes, you remember the way I explained it that day. Yes. So yes, help you determine impairment loss of those assets, but why can't we use those assets to determine their impairment loss themselves? Why are we using CGU?
Those assets themselves don't make money.
Because they depend on others.
Those
Good.
assets themselves don't make money.
Good. So what would CGU help us do? CGU will help them determine their recoverable amount, especially their value in use.
Who
So
is
it is
writing this on the screen?
it's Aisha.
Ah,
It is when you group these assets together that you will be able to know how much these assets generate together. And that's what CGU helps us do. Now, you see, the main thing is not that. The main thing is this. When they give you CGU, I'm coming. Let me just stop sharing and we share so that those things appear. Okay. So the main thing for CGU is this. They will give you, for CGU, they will give you a recoverable amount of a CGU in the exam. Usually they will give you value in use.
And
They will give you the value in use of a CGU. Let's say, let me mute. Let's say the recoverable amount given to us is 100. They will now give you the carrying amount of, let's say, they will now break down the assets, plants. Let's see. Machinery. So, 25. F and F. What's the addition of all this?
Yes. 100.
No.
110. 85.
Is it 110?
No. 5.
50?
110.
Yeah.
110, yes.
110 plus 55, 110.
It's 110. Sorry, sir.
50 plus 60, 110. Okay. So from here now, they will now tell you that the NRV of the F and F is 20. I'll say the NRV of the F and F is 20. Okay. So they now ask, I'm just assuming, they will now say, okay, calculate the impairment loss of the CGU. So first, the impairment loss of the CGU is how much?
10.
Just 10. After you have calculated that 10, you need to do what?
Allocate it.
Degree of impairment.
Allocation of impairment loss, Abi?
Yeah.
Yeah.
In you have and
Machinery, furniture and fittings.
from F and what?
Goodwill.
Goodwill.
So why did you indicate the net realizable value of F and F is 20 again?
Is to guide,
That in the question.
because
If they
it's
give
to
you like,
guide you as to how to answer it.
yeah, you know, in some cases they might not even give it to you. They might not even give you. But I'm just assuming that okay, if the examiner gives you an NRV as 20, so how would that impact your impairment loss calculation? So let's look at it and see. So what's the carrying amount of the plant? 30, Abi? Machinery 25,
20.
20, and
35.
So let's allocate impairment loss. So this 10, how do we allocate it?
You first give to physically damaged goods. If you have left, you give to goodwill. And then if you have left, you then share among the others on a pro rata base.
That's fantastic. That's fantastic. So
Sir,
I
is
need
it
to change.
goodwill, sir? Is it goodwill first or physically damaged asset?
Physically damaged first,
Okay.
Is yeah, it's physically
then
damaged.
goodwill.
Okay.
Please let me change these figures here. This thing will not make me calculate. I want to calculate. So this will be 155.
That's 155. Our impairment loss is 55.
Let me change this one to 50. So this will be how much?
165.
165. So our impairment loss is how much?
55. 165.
65. So now we don't have any physically damaged assets. Okay.
Okay.
But
So
we
the
have
next impairment loss will go to where?
goodwill.
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 We'll give it 35.
We'll give it 35.
25 to be fully.
Then the next
Mhm.
one will go to where?
So the
Next
Others
next
will
one
now,
for
be
F and
correct.
F, we can see that it is
go
not
to
impaired at all because the net realizable value remains the current amount. So we share the rest between the plant and the machinery.
On the machine, yes, the F and F we mix that one.
So how do you know that the F and F is not impaired?
Because they gave us the net realizable value.
That
And
is
it's the same thing
220.
as this is like the new current amount. So it's still the same.
Okay, good. Fantastic. That's what I need you to understand here. So if they didn't give you this at all you have done is, what you would have done is the remaining 30 impairment loss, we will have shared it
Sure.
among these three on a pro rata basis.
That
But
would be
the
75.
examiner gave us the net realizable value of the F and F as 20. So since they give us this as 20, it means that the F and F, exactly, you cannot write it below its net realizable.
Mhm.
And that's how they will give you in the exam. So that means this will be 0.
Mm.
So that means the remaining 30, you will share it among plant and machinery. So how much will plants take? That will be 30
30 over
divided by
Over
55
55
times
times
30.
our 30.
Good. What about machinery?
25
25 over 20
over
over
50,
55
over 55.
times 30.
30. And that's it really on impairment loss.
The current amount.
Mr. Wasu, is it possible in the table like this, our furniture and fittings to be 25, then they write the net realizable value to be 20? Is it possible?
They will mostly give you this way in the exam. So let's even
Same
assume,
values.
yes. So let's even assume what you have said. Okay. You are saying that if this was 25,
Yes.
Abi?
Yes, sir.
Yeah. And they give us this at 20.
Yes.
So
So it's 5 we are going to consider.
We add 5 to the proration.
Yeah.
Exactly. Not that we have time 5 to
We
the
don't
police.
add 5 to the proration, no.
As
That
in,
means
when we
this
are
one
getting
is
the
like
total.
impaired
The
by
total.
5. So whatever we are doing, we first give it 5 impairments first before we
5%
share
of
the
it.
others.
Exactly.
That'll be
It's not
5.
5% of it, too.
That'll be
They are
5
saying that
over 60.
this
5, it will
no.
be 5 over the
60 now.
Calm down, calm down. Let's use one person, Joe.
Okay, from what I understand,
yeah,
it means that this this F and F is already impaired by 5. So whatever you are doing, first give it its own 5 before you start sharing.
exactly.
Okay,
So
okay, that's true.
if it's this case now,
It's even that we do before our goodwill.
Exactly.
Yes, you're right. Abi?
you do goodwill first.
Oh, wait, no. I thought them doing this already means that it's like physically damaged for them to have brought it down with
reduce
loan.
the annual, yes.
It means that it's physically damaged. So I was thinking that we'll give it to it first before we do that goodwill and before we share the rest.
Yes. It's like an indirect physical damage.
Well, not so much of a physically damaged asset like that. So it's just I won't say it's risky to say it's physically damaged. It's just the fact that the realizable value is just lower right now by a specific amount because every impairment itself is so since the examiner did not say it's physically damaged, that means it's not physically damaged. It's other issues with it. So settle your physically damaged, settle your goodwill, right? In this scenario, you have enough to go around. I can assure you that if they give you this kind of scenario in the exam. So after you have settled your physically damaged, settle your goodwill. So that F and F, the scenario Adiago painted, you just come and give this one 5. Just so that you can write it down from 25 to exactly this 20. To exactly 20. So the remaining is now what you now share among these two. Okay, so good observation. But in this case now is 0. So you whatever you get here, you put it here. Whatever you get here, you also put it here, and you will then get your carrying amount after impairment. And that's it. That's everything for impairment.
Sir?
Yes.
Okay. Concerning the damage or partially damaged asset rather, is it going to be expressly stated that so asset is damaged, or how are we going to identify it in the
They
question
will
of
tell
this?
you. They will tell you specifically.
Okay.
They will tell you specifically that it's damaged. Okay. So that's for impairment of assets. Which one again? Okay. Let me just do, it's already 1 o'clock. So let me do one more for you. Non-current assets held for sale and discontinued operations. So for non-current asset held for sale, this is looking at a non-current asset that you were using in your business before, but now you have changed your intention to sell it. You have not decided to sell it. So when that kind of decision is made, that you want to now sell an asset, IFRS 5 says that you need to reclassify the asset as a non-current asset held for sale. If that non-current asset is a plant, that plant will no longer be plant under non-current assets. It will now be a plant under current assets, which you will call plant held for sale. You shall put for sale behind it. Just, after the name, just to show that, okay, now you are not using this plant for your operations continuously. It's like the aim of holding this plant is not to use it into the foreseeable future anymore. The aim is to sell. But before you can classify and put that name for sale after a non-current asset, there are conditions that must be met, and there are 2 of them. Number 1 is that it must be what?
Available for immediate sale in the present condition.
Okay. It must be available for immediate sale in its present condition. And what's number 2?
It must be marketed at a reasonable market price.
No, the way I told you is that the sale must be highly probable.
No,
That's the
okay.
second one. I now broke down this highly probable into 5. I said number 1. Yeah, and that's when what you now said will now come in. Is that
Okay.
it must be marketed at a what? At a reasonable price. A bit. What again? It must be sold within
1 year.
1 year.
within 1 year. What again?
There was intention to sell.
No. What again? No. These are
There must be a market. I don't know if there's not listening to, must be a market to sell something.
no.
And available.
The people we have been hearing their voice, are they Agbo? Why have we gone quiet?
Oh, we've not revised this one.
Why won't you revise this one? The simple one.
We are doing the more advanced one first.
No. Should have done those ones since so. Yeah, I'm waiting. No.
There
Elumi.
must be a contract.
Contract.
Sir, I'm trying to.
There must be a buyer.
There must be a buyer. Mhm.
Okay, yes, there must be an active program to locate a buyer. If you see there must be a buyer, they will
Oh,
mark
that's
it.
like active marketing, Abby.
Yes, they will not give
There must be
you
marketing.
which one again?
Management commitment.
Yes.
All this online class, if it's no, they attend well.
Which one again?
Like, it must be sure that they'll sell. There must be no any unforeseen events that will not make them sell. And there will be no change in plan to sell. Hey, God, please.
These are the things I really need you to be familiar with. Stuff like this. Or if they ask you this in the exam, these are your go-to questions that you must make sure you attempt in exams. So now, if you meet this condition, then how do you measure non-current asset held for sale?
Lower of the carrying amount or their fair value less the cost to sell. Less cost to sell. Looks like this one is content everywhere.
So let's assume that the carrying amount is 50 and the fair value less cost to sell is 60. So how do you measure it?
The carrying amount, you measure it at 50.
At 50. So let's assume the carrying amount is 70. And
You measure it at 10.
And this one is 80.
Carrying amount on at 70, the lower.
Okay, let's say this one is 60.
NRV is the lower, measure it at 60.
Okay, so what then happens to the difference in this case? Because in this case, you are writing down the value of your asset from 70 to 60. What happens to the difference? Where do you take it?
That's a loss, impairment loss.
That's correct.
I think it's true.
There's an impairment loss of 10. Okay.
Shano, Elumi.
Don't mind them, Jerry. When you're not all in class at the same time.
Mr. Wasu, please, can you share the video of this class again? This IFRS 5.
All right, no problem. I'll do that.
Thank you, sir. But I don't know anything here.
It was on this online. Even me, it was an online class. That's
I'm a
why
serious student.
I'm struggling to
Okay.
follow.
Okay. So basically this for non-current asset, and there are some other issues around non-current asset held for sale that I also mentioned. Like for example, now if the entity decides that it's not selling again, that they want to start using it back in their business. So I told you that means it will go back as being a non-current asset. Then how do you measure it in that scenario? I told you that it's going to be measured at the lower of the carrying amount and the net realizable value at the date of reclassification. But that one, even if you leave that alone, what is key is that another thing you need to know very carefully when it comes to IFRS 5 is that when a non-current asset is held for sale, depreciation on that asset will stop. When a non-current asset held for sale, when an asset is held for sale, depreciation on that asset will stop immediately. You stop depreciating the asset. You stop depreciating the asset. So if you have a situation where you have a non-current asset held for sale, you now say, okay, I want to start using it back. I don't want to hold it for sale anymore. So that goes to show that, you see, all the depreciation you have not calculated, that you stopped calculating, you need to now calculate it. You need to now calculate it and get a new carrying amount. You now compare that with the net realizable value. The lower is what you take, okay, in that case, right? But just even know focus on knowing this one that you have on the board to a large extent. And another one you see the examiner talking about is discontinued operations. So, and the key issue here around these discontinued operations is when you have a component of an entity, like you have a branch, and you decided that, okay, you don't want to continue to operate this branch. You want to shut it down. Maybe in the next 2 years, in the next 3 years, or maybe you have even shut it down itself. That's a discontinuing operations. See, IFRS 5 requires that when you have such a branch or a segment of your organization that you want to discontinue, it says when you are preparing your statement of profit or loss, you must separate continuing operations. You do the revenue, cost of sales, up to your profit for the year. For that one separately, you will now do the discontinuing operations also. You do that one also separately. Revenue, cost of sales, everything separately, like that, up to profit for the year, for the discontinuing also. And they have asked it severally in your exam, where they will give you 2 branches and they will say, the company want to discontinue one of the branches. They will now ask you to prepare P&L. They will give you the P&L of the 2. They now say, okay, prepare the P&L for the company. Very simple, but all they just want to see is that you are separating the one that they are still continuing. You do the P&L for that. Then after you have gotten profit for the year of that, below that, you do the discontinued operations for that other one that they want to discontinue as well, like that. And that's what is really, really required here. Okay. I'll have to stop here now because I don't plan to spend the whole of your day on there. I just want to revise one or two with you. And I believe strongly that all of those standards I've taught you, by now you should be able to summarize everything. You should be able to sit down and do a high-level summary of everything. If you want to continue, I mean, it will take another 2 hours for me to finish up. I would have really loved to do that, but I mean, you really have to also go and read. So there are still some standards I really want you to go and revise. Go and revise IFRS 15. You might not, at this point in time, this is not the time where you go deep down. You should have done your deep down before now. Okay. At this level, it's just peripheral revision. You should have done your deep reading before now. So, but you know, no sweat. If you are just still doing deep reading, I mean, hopefully, just that ICANN is wide. There are a lot of things you need to know. So if you see the guide I'm giving you, it's a lot of topics. Like I did cash flow with you, I did EPS with you, I told you to go and revise ratio, and then I did published with you, because I know those ones, there's a high likelihood that they will find it there. And I talked about income tax, that we didn't have opportunity to revise that. Then I tried to do some summary of these standards. Conceptual regulatory framework is there. You need to know this, all of these things. Like you need to have known it. So go and revise revenue. Go and revise. I would have loved to revise this one, but I mean, I just have to leave you right now. Financial instruments. Go and find a way to revise it. IAS 20 and
40.
IAS 40. Okay. Revise those ones. If you have little time, I mean, those ones I've mentioned that's coming out from my mouth. And in fact, this one is, you can leave this IAS 8 if you have not revised it, because it's technical. Adjusting those retained earnings and all. It's just, if you don't know it by now, it will confuse you a whole lot. Okay. And it's something you can easily find in your exams. So at least if you can pinpoint those ones, you have at least at a bare minimum, you must have read those ones deep down at the very bare minimum. Then